Hello and welcome to SIPS Level 5, Advanced Diploma in Procurement and Supply. This is Module 3, which is Managing Contractual Risk, and it's Learning Outcome 1, which is to understand and analyse the legal and processes issues relating to the formation of contracts. Now, on completion of this module, you will be able to evaluate the legal and process issues relating to the formation of contracts and the legal implications of contracts non-conformance. You'll also be able to assess the impacts of breach of contracts and examine coping remedies and provisions that are available under these circumstances. But this is session 1, where we'll cover the legal and process issues relating to the formation of contracts, specifically issues and the risks, as well as the implications of elements of contractual documentation. So clearly, some understanding of basic principles of contract law is essential when contracting with suppliers, as all purchases, whether they're goods or services, should be subject to a contract. And contracts are legally binding, whether they're verbal or written. There is also a wide range of documents involved in any contract law. So a contract is a statement, written or oral, of exactly what two or more parties have agreed to do or exchange. It covers the conditions and contingencies which may alter the arrangement, and the rights to each party if the other fails to do what they've agreed. How responsibility or liability will be apportioned, and how any disputes will be resolved. Contracts and contract management also involve a wide range of documents. But before we go any further, let's look at the conditions of a contract. There are 5 requirements that a contract needs to become legally binding. So firstly, an offer, a full statement of what the person making is offering or willing to provide, and the terms upon which they're willing to provide it. And that can only exist if it's communicated to the other party. But there are 6 ways in which an offer can cease to exist. Withdrawal, or sometimes known as revocation. It could lapse in terms of time. Death of the person making the offer. If the person being made the offer rejects it or makes a counteroffer. Failure to comply with the conditions. But the final one is acceptance. So once an offer becomes accepted, it becomes the start of a contract. So acceptance can only occur when the offer is still open and must be absolute and unconditional. Letters that state subject to contract are not formal offers of any acceptance or any terms referred to within it. They just indicate that the party intends to accept a tender, usually subject to certain preconditions that have to be met. Acceptance doesn't need to be explicit. It can be implied by actions, which is known as acceptance by performance. So, for example, if a purchaser uses goods supplied, it can and will be implied that they've accepted them in the terms they were offered. But if the purchaser doesn't use them or otherwise interfere with the goods, then his silence on the fact that their delivery cannot infer that he has accepted them. No payment can be demanded. In legal terms, contracts are bargains. One thing are given in exchange for another, and this is the consideration element. It glues together the offer and acceptance. It's the things we exchange. Now, in commercial contracts, it's usually the promise of payment for goods or services being provided. It normally is financial, but in legal terms, it doesn't have to be. You could be just exchanging things of equal value, like payment in kind. For a contract to exist, there must be consideration and it must have a value. If there's no consideration, then there's no contract. Sufficient consideration means something that has monetary value, and adequate consideration relates to whether or not payment is a reasonable or a fair amount to be given in exchange. Now, the expression intention to create legal relations and the intention to be legally bound mean the same thing. They mean that they're mutually agreeing to be intended that the agreement set out is enforceable. Now, in commercial agreements, it's generally assumed to be intended to be enforceable, but purely domestic arrangements are thought not to be. And the final one is capacity to contract, meaning the person has legal capacity and legal competency to enter into a contract. People without capacity to a contract would include infants and minors who are under the age of maturity, which is usually around 18, or people who suffer from mental health issues or are under the influence of drugs or alcohol. But within procurement, it means that the party has capacity to act as an agent on behalf of the company they're representing. And if a person without capacity enters into a contract, it will not be legally binding. It may, however, be binding upon the other party. The reason for this is that the purpose of the rules of capacity are to protect those who may not be capable of making informed assessments. So looking a bit closer at the offer element, in order for a valid offer, there needs to be an expression or willingness to enter into a contract on specific terms and an intention for the contract to be binding once it's accepted. And the key difference between an offer and an invitation to treat is that an offer is specific to an individual person and an invitation to treat is broader, where it can be advertised to the world at large. So an offer is a promise to make a promise is made with an understanding that the parties will be forming a legally binding relationship. They're specific and clear in terms of the terms, and certainty is demonstrated in the actions and words which communicates a commitment to the offer. There is no room for negotiation. All terms are already negotiated and have been accepted. Now, a counter offer destroys the original offer. Counter offers are offers made in response to a preceding offer, which changes at least one of the key elements. A request for information to clarify an offer is not construed as a counteroffer or an act of acceptance to the original offer. The original offer still remains, as the offeree has not implicitly or explicitly accepted or rejected an offer. So what we're seeing here is case law by Hyde versus Wrench from 1840, where Wrench offered to sell Hyde his farm for £1,000. But the defendant counter-offered 950, which was refused by the claimant. And subsequently, the claimant then offered to accept the defendant's £1,000 original offer and was refused again by him. So the claimant sued for breach of contract. And the issue here was whether or not the claimant accepting the original offer after making a counter-offer was still a valid contract. But it was held that no valid binding contract existed between them. Could have been possible if they had accepted the counter offer or the original offer. Specific performance is an equitable remedy in a law of contract where a court issues an order requiring the party to perform a specific act, such as issue complete performance of the contract. Now, acceptance needs to be final and unconditional expression of interest to accept an offer and enter into a contract. And that can be done by signing a contract or by giving verbal agreement, but it must be unconditional. It must mirror the offer being made. As soon as you start to alter it, it becomes a counteroffer. It must be communicated to the offerer and made within the period of validity. Now, beware of acceptance by performance, which can arise when a supplier changes some elements of contract delivery or performance without the express permission of the buyer. If the buyer allows it to happen, it could be argued by the courts that the changed terms have been accepted by the buyer, especially if they've been paid and the supplier invoices have cleared since the changes were made. But silence cannot be acceptance in case law. And this is a very famous case on acceptance called Felthouse versus Bindley. And in this particular case, a nephew discussed buying a horse from his uncle. He offered to purchase the horse and said, "If you don't hear from you by the weekend, I will consider him mine." The horse was sold at auction by mistake, and the auctioneer had been asked not to sell it by the person, but the auctioneer had forgotten. The uncle completed proceedings against the auctioneer for conversion, and the action depended on whether there was a valid contract between the nephew and the uncle, but it was held there was no contract because silence alone is not acceptance. And as I said a moment ago, there is a difference between an offer and an invitation to treat. The latter doesn't constitute an offer in law, and so it's not part of a legally binding contract. So an offer is more specific and more obviously directed at an individual or an organisation, whereas an invitation to treat is an offer to the world at large. Another way to think of the difference is that an offer must have sufficient details for acceptance to enter into a legally binding contract. So there must be full details of the terms and conditions and the contractual terms, whereas an invitation to treat doesn't need to have these. It's literally an invitation to enter into a discussion and negotiation, as opposed to intending to be legally bound. So there's an invitation for parties to make an offer and no formal or legal relationship between any party. You could have a request for information where parties find out what's required or can be provided to help decide whether an offer should be made. There is a lack of certainty and there is no commitment to any actions. And there is room for negotiation and discussion. So here's an important case law illustrating invitation to treat. The Pharmaceutical Society of GB versus Boots Cash Chemist. Boots introduced the new self-service system into their shops, where customers would pick up goods from the shelf and put them in a basket and take them to the till to pay. The Pharmaceutical Society of Great Britain brought an action to determine the legality of the system with regards to the sale of pharmaceutical products, which were required by law to be sold in the presence of a pharmacist. The court ruled that they needed to determine whether or not where the contract came into existence. So what it was held was that the goods on the shelf constitute an invitation to treat, not an offer. A customer takes the goods to the till and makes an offer to purchase. The shop assistant then chooses whether to accept the offer, and the contract is therefore conducted at the till in the presence of a pharmacist. Precedence of documents. This is a clause that clarifies which document takes precedence over the others in the event of any inconsistencies. And inconsistencies may not come to light until the contract is underway. So an order of precedent clause is useful in situations where there are many documents written by different stakeholders and long-term projects where it's likely that individual stakeholders and points of contact, such as the project manager, might change. So there are likely to be inconsistencies when projects are large and complex and require large amounts of documents and details. But some contracts call for discretion to be exercised by the relevant project or contract manager, as there are some elements of risk. Risk is uncertainty from other stakeholders as to which documents take precedence, and risk uncertainty if a project manager changes over the course of a large complex project and runs over an extended period of time. You need to consider when the order of precedence clause is located or where it's located, how it can be worded, and the construction of the contract. So, for example, if the clause states that the contract takes precedence over all other documents, this would include any appendices which potentially contradict each other. It's therefore good practice to reference specific documents or include wording such as, "This contract excludes its appendices." If the contract is silent on the order of precedence, it's assumed that all documents have equal significance. Variations to contracts should not be taken lightly and should be treated with the same care and attention as drafting clauses used to the formation of contracts. Now, contract changes is when changes to a contract are required when there are fundamental changes to the original need for a product or service that was contracted. So, for example, in employment contracts, contracts need to be changed when an individual is promoted to a different role, or if they wish to make a fundamental change to their working hours. The buyer needs to follow the organisation's contract change process, which usually involves contract change notices, or CCNs. A contract can be changed at any time, provided that the parties are able to express acceptance to this change. And in the event that the change occurs suddenly, which changes the contract in advance of acceptance, it would be reasonable to allow a window of time for any changes to be agreed while the terms are negotiated. Now, from a procurement perspective, it's important that the buyer follows the organisation's change control process. But with contract variations, they look at making slight adjustments to the contract in order to make more relevant to the circumstances surrounding its performance, as opposed to changing the fundamental aspects. So the organisation's contract change process should be followed, and there'll be a variation clause that states any amendments that are made to the contract are ineffective unless they're made in writing and signed by both parties. This prevents either party changing its obligations as it pleases, and it helps provide consistency and understanding to all parties at all times. A notification of a change is not enough. There must also be some form of consideration to support the agreement. This may be presented as mutual surrender of existing terms or rights, a new benefit being granted by each party to the other, or additional benefits of the parties in the event of a breach. Now, when agreeing a contract variation, you need to consider the impact it will have on the rest of the contract. So, for example, if the contract price is reduced by a fifth, consider whether the liquidated damages should be reduced by a fifth. In the event of no variation clause in the contract, the safest approach is to communicate with the nominated point of contact that's identified in the contract. Any changes in the law or regulations that apply to a particular industry may need to be considered. For example, building regulations may change partway through a construction contract. So it's important, therefore, to have good practice, to have the change reflected in the contract in order to make the performance legal. Now, indemnities, liabilities, and insurance are different methods for reducing risk. Indemnity is an arrangement in which one party promises to compensate another party for a specific event known as a trigger event. Indemnity clauses are explained as they're used to help manage the risk associated with a contract. They allow one party to be protected against the liabilities caused by the actions of another. And they should be requested when a party is likely to incur a loss as a result of a transaction, and remedies which are available for a damage claim, and that wouldn't be sufficient to cover the loss suffered. They're frequently used for the assignment of intellectual property rights in software license agreements and in share purchase agreements. Some losses cannot be indemnified, like losses caused by deliberate acts of the receiving party or by the receiving party's own crimes. Liability is next. This is a legal responsibility. So, for example, in employment contracts, companies are liable for the costs of compensation for employees who are injured at work, as there is a duty of care to look after them. Parties will often seek to limit liabilities in contractual or commercial contracts, and each party will want to restrict the level of risk their organisation is exposed to by limiting their own liability, maximising the others. So there's usually some negotiation. And the following are examples and good approaches to explicitly exclude liability for certain types of losses which may occur during the contract, or to put a cap or limitation on the value to which a party is liable for. Now, when drafting a clause that limits the liability of a party, contract regulations, limitations and exclusions and references should be considered. And then finally, insurance, offered as a guarantee for compensation with respect of certain events like loss and theft in exchange for a premium. Insurance clauses are commonly used in agreements involving distribution, licensing and manufacturing and product trials. In order to ensure the ownership of risk falls to the relevant area, the buyer should do the following. Firstly, analyse the risk and relationship. Secondly, create an opportunity for the appropriate insurance and indemnity clauses to be considered. And third is to report claims promptly. When drafting the requirements for an insurance contract clause, you need to consider wording, duration and risk insured. The practice of risk transfer should permit a buyer to be responsible only for the activities where they're directly responsible and to allow them to focus on their operations. Now, the obligations to maintain insurance against commercial risks when a clause is placed in limitation of liability, they're not the same thing. Where a financial limitation on liability is required, the contract should also clearly state in a separate clause where the limitation is and under what circumstances it applies. In general, procurement departments will seek to include remedies in a contract, whereas suppliers will look to include a liquidated damage clause instead. And then we've got guarantees and warranties. Guarantees is a promise to perform an action on behalf of a party to a contract if they become unable to fulfill them. So, for example, landlords often ask prospective tenants to provide a guarantor, often a parent or a guardian in the case they're unable to pay their rent. Whereas a warranty is a promise to take corrective action in order to fulfill the obligations of a contract, like repairing an item that becomes defective shortly after sale. So a guarantee needs to be put in writing and is not recognised if agreed on an oral basis. A written contract must be made between the guarantor and the creditor, for example, between a parent and a tenant and the landlord rather than the debtor. This is to allow the creditor in the agreement to deal with the guarantor in matters relating to liability or debts owed by the debtor. Guarantees are commonly requested by a seller where there's a concern over the buyer's ability to fulfill their terms of the contract, such as the repayment for a loan. Banks that lend money to businesses may request personal guarantees from the directors or the company in the event that the business defaults on a loan, particularly if the business is a new startup and doesn't own any significant assets. Now, whilst the term penalty is commonly used, legally speaking, it implies some kind of fine or punishment for a contract and to that party who doesn't fulfill their contractual duties. Punishment in this way is not legally binding. And for liquidated damages clause to be binding, they should be fair and equitable in terms of the assessment of the damages likely to be suffered by one party if the contract is not fulfilled by the other. This assessment should be made at the time of the contract formation, agreed by both parties and stated in the contract. So the term liquidated means that the party who doesn't perform their part of the contract will have to pay the other. They're used to motivate suppliers to perform. Most common type would be a penalty clause for late completion of a large building or an engineering contract. An actual penalty clause is not enforceable. All that can be claimed for is a degree of loss incurred rather than something extra as a punishment. So the example here illustrates the importance of a structure to a contract. As A has a fixed amount and takes no account for the actual loss incurred, it's likely to be viewed as a penalty, whereas B has a clearly structured schedule and refers to it, like the difference between a warranty and a condition. In contract law, this often means not the words, but the matter and the meaning and the intention behind them to determine the validity of the term. So example A, in the event of a late delivery, the supplier shall pay the buyer a sum of £1,000 per day until delivery. Likely to be classed as a penalty clause because it doesn't take account of the losses incurred and would be unenforceable. What if that delivery was only worth £200? Is it reasonable to charge them £1,000 per day? Example B is in the event of late delivery, the supplier shall pay a penalty to cover the costs in the attached schedule representing the actual expenses incurred by the buyer. So likely to be enforceable because it's a pre-agreed displayed schedule, even though it's said that it's a penalty. Now, payment terms can be included in the contract, and it usually includes when the payment will be due, the payment method, and the type of payment. So we've got an open account, which is where goods and services delivered and payment is due afterwards. The preferred option for the buyer and the importer. But in international trade, exporters are able to mitigate the risk by using export credit insurance. Documentary collection happens when the seller's bank sends the delivery documents to the buyer's bank with all the relevant payment instructions, most common in international trade where the parties have a long-term relationship and a degree of trust has been built. It's similar to a letter of credit arrangement, except it's cheaper and less complicated. It's riskier for the seller as there's no verification process, and there are limited remedies in the event that the buyer or importer doesn't pay. Documentary credits offer a secure payment method for the exporter or seller by leveraging the creditworthiness of the bank to ensure a smooth payment process is followed. And the contract is made between the buyer and the seller, as usual, and the buyer asks its bank to issue document credits to the seller's bank. The seller's bank informs the seller once the documentary credit has been received. After the goods have been dispatched, the seller passes the necessary documents to the bank, which are then passed back to the buyer's bank. Once all the requirements of the process have been fulfilled, the seller receives the funds into the account from the buyer's bank. An advance payment is a payment that's either made either in whole or as part before delivery occurs. The most secure form of payment from a seller's perspective, but least preferred by the buyers. Mobilisation fees may be required to buy materials or machinery or prepare for the work to be done. Advance payments may also be used to take advantage of any discounts for materials which are available for bigger orders to get economies of scale. And letters of credit are an agreement between the buyer and seller's bank to transfer funds due to a contract completion upon presentation of valid documents, providing a guarantee that the payment will be made if valid documents are presented. It's used if a buyer and seller haven't worked together before. And the final thing for learning outcome 1 is to look at Incoterms. These stand for International Commercial Terms. They're devised by the International Chamber of Commerce to define the roles and responsibilities of the buyers and sellers in a contract, the risks relating to international trade and shipments, so who's responsible for replacing the goods if they're damaged, and it related to customer clearances. And these are used for contracts that involve delivery and transport of goods by land, air and sea. They do not cover the delivery of services. The terms are updated every 10 years and we're using 2020 at the moment. And that's to reflect current practices that are common in the industry at that time. Both the buyer and seller, if agree mutually, may refer to previous editions of Incoterms, especially if their business processes and relationships are better suited to a previous edition. It is important to refer to Incoterms when negotiating international deliveries so that both the buyer and supplier mitigate the risks associated with long-distance freight across national boundaries. They're not legally binding in themselves, but they often are included in contracts and specific details can be amended to suit the need. The contract terms should clearly state when delivery is considered to have been made, especially when the payment clause state payments are due after delivery has been made. Now, what you can see from the diagram on the slide is there are different responsibilities from a seller and a buyer's perspective, and where the risk goes from the buyer supplier is indicated by an X. There are 4 classes. You've got ones that start with E, F, C, and D. The E is only one actually. There's EXW, which stands for X works. The seller is only responsible to get it to the back door of their factory. The buyer has to go and collect it. Okay. The opposite end of that is the D terms, the most common one being DDP, which is delivered and duty paid, which is the complete opposite of X works. The seller takes it all the way to the buyer's warehouse and pays for all the costs associated. And the two that are different is the Fs and the Cs, and what separates the Fs and the Cs is the deep blue sea. So F terms get the shipment to the port of departure. The seller's responsibility is to get it to the port, either alongside the ship, which is FAS, free alongside, or FOB, which is free on board the ship. But they're not paying to cross the water or to move it the other side. The seller only is responsible to that port of departure. The buyer would then have to pay for the transport across the water and get it off the ship to its buyer's warehouse. And then you've got the C terms. And as I said, what separates the F's and C's is the deep blue sea. And the C terms need to ensure the seller takes it to the port of arrival. Most common ones is CRF and CIF. CRF is just cost and freight, which means that the seller will take it all the way to the port of arrival, but they won't pay for the insurance. The buyer would need to pay for that, which is why you can see the risk transfer there. And CIF is cost, insurance and freight, which means that the seller has to insure it as well until it gets to the port of arrival. So that's the end of Learning Outcome 1. Thank you for watching.